This podcast is made possible by VersaPay.
Hi, this is Brianna Gerber, CFO of Chromadex, and you are listening to the CFO Thought Leader podcast.
This is episode 891.
One of the most important strategic imperatives that we need to do together, and I need to lead, is really moving us from that single product company into a multi-product company. And the financial expression of that is that we see our net revenue retention grow to 115 or beyond. That may take more than 12 months. The other element of my scorecard is artificial intelligence. I'm not going to say that we're running artificial intelligence yet, but the idea is we're building the frameworks and the groundwork.
Hi, it's Jack. On today's show, we speak with Jim Cox, CFO of Clearwater Analytics. Back in 2008, when Jim Cox was a controller, his CEO asked him to accompany her to an investor meeting. Cox tells us he remembers grabbing a seat at the meeting while nodding and smiling and hoping no one would ask him a question. For Cox, whose accountant's resume included a 10-year stint at PricewaterhouseCoopers, the world of investors was something still rather foreign, and the meeting's biggest takeaway became repetition. According to Cox, typically there would be 20 investors looking for answers to the same 6 questions. Suddenly, what had been the unknown became a whole lot more manageable for Cox. You'll hear that story and much more after this. When your accounts receivable automation focuses only on back-office tasks, you forget the most important stakeholder, your customers. VersaPay gives you all the tools you need to automate those tasks, plus the collaboration tools to take on everything that automation alone simply can't. This doesn't just increase efficiencies and accelerate cash flow, but also creates a dramatically improved experience for your customers. And as the economy tightens, can you really afford to risk losing customers over an invoice-to-cash process they find frustrating? With VersaPay, clients typically achieve 50% less time managing receivables, 25% faster payments, 30% fewer past due invoices, and 81% customer portal adoption. Learn more about VersaPay's collaborative AR, ERP payments, and cash application solutions at versapay.com/CFO. Hello, we're speaking with Jim Cox, CFO of Clearwater Analytics. Jim, welcome.
Thanks. Great to be here.
So, Jim, we always begin by asking you to take a look back for us. What comes to mind when you think about the different experiences that prepared you for the role?
Yeah. I spent 10 years it started out to be Pricewaterhouse, and then it became PricewaterhouseCoopers, and I think now it's PwC. And I learned a couple things there. Number one was just to be curious. Like, here I was, 22 years old, I didn't even shave, and I was headed out for my first audit by myself. And I'm in a room with executives, and there's certain things you're supposed to ask, but I always just was curious, like, how does this business make money? Why are they here? What does that work? And lo and behold, what I learned really quickly was you're with these people who have all this experience, and if you just ask, they will share their story, right? They will share a story with you. And so very quickly, I was really able to think through these, and there was a breadth of also different opportunities. So you would understand the special sauce. And so I think that you start to learn those patterns to try and understand what's the special sauce. The second thing is I just learned to say yes, right? I started in Columbus, Ohio. I'm from southeastern Ohio, really rural. Columbus was the big city. after 2 years in Columbus, I noticed the curvature of the earth was a little broader. And so I said, hey, perhaps I could go to another city. And the partner said, sure, we'll send you to San Francisco. There's this company called Chevron there. Maybe you could work on that. I said, great. I've heard of San Francisco. That's great. And then a couple of years after that, somebody with a funny accent called and asked me a question about, oil and gas accounting, really exciting stuff. And then the guy with the same funny accent called me back the next day and asked me another question, and I answered it. And he called back a third day, and he said, we could use people who answer questions like that here. Would you mind coming to New Zealand? And this was before the 100% Pure or Lord of the Rings or any of that, right? They were filming Lord of the Rings at the time. So, frankly, I called my father and I said, should I go to New Zealand? And he said, I can't think of a town in New Zealand, but yes, right? And so, so went to New Zealand and spent a couple of years there. And so got to go all around the world. And then the last thing is there's so many repetitions in an organization like that. You probably have, 10 to 15 clients that you're interacting with. So those are different companies, right? Each year. So you have so many repetitions.
Can I just ask?
Yeah.
I'm sorry, Jim. I just want to interrupt. It's an interesting story, and I'm curious. Is it PwC you're with when you land in New Zealand, or was it a client company that lured you over there, or how does that work?
There was an oil and gas company that was a client of PwC in New Zealand, and they were actually a U.S. registrant, and so they kind of had stuff going on, and so PwC, packed up my bags and sent me there for 2 years. It was
you were honestly, on site at the company's offices.
Yeah, at the company, but working for PwC, right. And honestly, it was I was really paid to speak American in New Zealand. It was kind of, okay, let me tell you this is how it works in America. They were all like, okay, great. I didn't know what I was talking about, but they didn't either. So it worked out. So yeah. And then, just lots of repetitions, and that then teaches you to reflect. And I think one of the big important things that I've learned is there's always something to learn. It may not be what you thought you were going to learn, but there's always something to learn. So that was 10 years. That was a great background. And then I left to work at a client. Actually, I went to it was a public company that was, a real rocket ship. They sold cell phones to the Chinese. So it's like, how can you go wrong in the early 2000s?
And you're back in the States?
And I'm back in the States. Yeah, sorry. I finished up my career. Sorry, I went to New Zealand. Finished up my career coming back to the Bay Area again. And that's when I started working. That was about the year 2000. So all the clients were, that was when pets.com was going on, and a lot of .com experience during that window.
But you did not join at .com.
I did not. It was, so they sold cell phones, and this was this company that had done wonderfully. They'd gone from, well, let me just explain what that company did. Was they had it wasn't really a cell phone. It was a cheaper, simpler phone. And so if you think about it, in the United States, we had all this wireline and all this stuff, but in China, they hadn't built that infrastructure yet. So it was a very simple kind of, you would put one tower in the middle of a city, and your 10,000 phones would work with that one tower, wouldn't work with multiple towers, but it would work with one. So, as you're going to these rural towns and putting these towers up, it grew. So it, doubled, tripled, quadrupled, was just an incredible growing. But what happened there, I describe that as my 10 years of experience in 2 years of life. And it was one of these situations where it just grew too fast for its infrastructure and really was, out of control. And so I spent 2 years there. And then I guess the other thing I learned at PwC was be nice to your clients, because one of my former clients at PW called me up. He was the VP of Finance at Advent Software, and he said, "Hey, I'd love for you to come work for me there." And so I went to Advent as the controller. And there I was like, what I'd recommend to anybody is when you get to an organization, figure out how you can help. Like pretty quickly, you can kind of ascertain whether, oh, I can help here or not. And then, show that impact, make that impact right away. And so that's kind of what I did. And lo and behold, more opportunities would come my way, right? And so that's ultimately the bridge from being like kind of an accountant into a CFO. Finally, the last step on that staircase was at Advent, where Stephanie DiMarco was the CEO, and she promoted me to be the CFO. And from there,
Was the company public yet, or
the company
when you
was
joined it?
Advent was public, and in fact, I like to say I was a public company CFO for 22 quarters. You live a quarter at a time in a public company. Yes, Stephanie was a very famous founder and CEO. She actually had taken that company public in 1995, and it had been an incredibly successful. But she was very famous for taking the company public because she was actually pregnant when she was on the IPO roadshow, and so she said everybody remembered me because I was, first of all, a woman CEO, so she built a tremendous business and a great heart, and it was just great to work there. Basically, what that business did was accounting and reporting for investment managers, and eventually went through, and kind of after 5.5 years, we ended up selling it, and then obviously after selling it, stepped away, and I was the CFO at a few, kind of not necessarily startups. They were scale businesses, but pre-IPO businesses, and then finally landed at Clearwater in 2019.
So that's a nice overview for us. I just want to point out to the listeners that the early part of your career, that first 2 decades, you really did dedicate quite a few career years at both Price Waterhouse as well as Advent Software. You were at Advent nearly 10 years.
10 years, yeah.
Yeah, and similarly, you were quite an extended stay at Price Waterhouse, which I think is important. And, I think we see frequently with a lot of finance leaders who, the early part of their career, many of them stayed where they thought they were learning and having opportunities in front of them.
And I think what I would say is, I agree with you, and I look for that as well. I would also challenge the listeners to say it's the same place, but what am I doing differently every 2 or 3 years? You don't have to change the name on the front door to change what you're doing. And so as long as you're growing and evolving, then, and frankly, building friends who are looking out for you to try and offer up those opportunities, it's a great early career step.
You could have probably stayed in oil and gas, gone to an oil and gas client. I don't know if you were, but you had a few tech, obviously, clients as well, and you jumped to Advent. Did you give that a second thought when you did it, or it was, one or the other at that point? You had enough experience in both realms.
Yeah, it's funny. All roads in oil and gas in North America lead to Houston. And I really like the Bay Area. And all my friends in the Bay Area were in tech. And so you started to think, okay, well, how do you, could that be interesting? And kind of when I made that transition in 2000, it was, just this incredible growth opportunity. So I think it was a little bit about moving to where the opportunity was. One of my first clients to kind of bridge that was a software company that served kind of the power generation and distributed power, which these days is then it was pretty cutting edge. These days, the concept of distributed power and the monitoring, remote monitoring around that is interesting. But that's where I learned. So I would say software is the best business to be in, because you learn, if you're curious, because not only do you learn, like, you've got to learn how to build software, you've got to learn how to sell software, you've got to learn how to serve your clients, but you also, like, you are solving a problem application software in particular. I think security software, I'm not sophisticated enough to really understand that. But if you're thinking about application software, you're solving a business problem that's somebody else's problem. And so not only do you have to learn like your business, you also have to learn your client's business. And so for example, like at Advent, we did portfolio accounting. Well, guess what? I was an accountant. I kind of knew the problems that our clients had. And so it made it just real and more robust. And so that was kind of, I'd like to say I had it all planned out, but that's probably in retrospect, I was able to recognize that, but hadn't up until then.
You shared with us Advent was eventually sold, I guess, and I just was thinking, almost 2/3 of your time there, I think, was spent in the CFO office, and your relationship. You had a strong relationship with your CEO, but as you progressed, you arrived as a controller. Was it always apparent that the CFO office was only 3 years away? I mean, did it surprise you that you landed there quite in that fashion? No.
No, it's always better to be lucky than good. But sometimes it's good to be both. And I'm sure there's someone out there that is, but I'm just lucky. So we had really great kind of finance leadership. And when I joined, our CFO was Graham Smith, and he left a year afterwards to become the CFO at Salesforce. And he left when Salesforce and Advent were about the same size, right? But that's gone on. So he's gone on to have a great career. So that opened up an opportunity, right? His taking an opportunity opened up an opportunity. And that was not when I actually stepped in immediately, but as we kind of went through those steps in that process, I got increasing levels of responsibility. And coming from the accounting side, it was a very safe set of hands, but I didn't know investors at all, nor even like, how do you speak to them? What do you do? And that's where, I think Stephanie, without telling me or even knowing, had a little bit, she was like, I'm not sure whether this will work, but let's try something out. So she just brought me along. She said, I'm going to this investor meeting. Can you please come with me? I carried her bag, and I didn't know anything. You know what I mean? I just sat there and smiled and hoped no one asked me a question. But eventually, when you hear kind of, again, it comes down to repetitions. When you go to an investor day where you're meeting 20 investors, guess what? All 20 investors ask 6 of the same questions and 2 questions that are unique to them, right? So then you suddenly start to say, okay, I can understand. They may be asking it in different ways or about different things. And so as that got rounded out, I think that's when, the board became comfortable and understood that. So.
And you found yourself suddenly being pulled into calls with investors, or, I mean, sort of like the investor relations exposure suddenly,
Yes.
you received and found yourself. Was there a time, and I do ask this question from time to time, was there a time you recall being brought before the board to give a presentation for the first time? And maybe it was at Advent, but maybe it was your earlier company. As you look back and you think about when you were in those sort of in the hot seat for the first time, anything come to mind?
So this is really interesting. After 10 years at PwC, you're in a number of audit committee meetings, right, for your clients. And that's why I actually bring everybody on my team to sit into these audit committee meetings, just so that they may not say anything, but they can see, like, because everyone thinks, oh, what's the magic? How does it look, behind this door? And I had seen how meetings went well and how they went poorly. And I remember I went to one meeting and I remember thinking, that went okay, and everybody came out saying, that's the best meeting we've ever had. And that's when I knew, okay, I can help. Like, there's things I can do to help. Like, this isn't rocket science. So that's kind of,
Well, we might have a few more career-related questions for you a little later, but we'd like to jump to the business segment of the podcast, where we always begin by just telling you asking you to tell us about Clearwater Analytics. What does this company do? What sets it apart? What's it about?
So yeah, so what we do at Clearwater Analytics is we provide investment accounting, reporting, compliance, and risk solutions for insurance companies, corporations, and asset managers. And so let me explain the problem, right? So that's what we do. Now, why? And then I'll explain the problem of why that's like, why would anyone pay to do that, right? And then I'll explain kind of our secret sauce, if that's okay.
Sure.
So it's complicated. You probably have a 401k. I have a 401k. You can go and you can see what your equities are. And, boy, how complicated can that be? Well, when you start thinking about lots of different asset types, particularly fixed income, and when you start thinking about having a bunch of different counterparties, as you think of you're a global Fortune 500 company, you have lots of different investment managers, you have different custodians. By the way, your operations are global. So, and oh, by the way, you have a bunch of regulations you have to follow. And those are different in Europe than they are in North America. The instruments, the derivative instruments, all of these things, how do you account for all of that? And there's just been an explosive growth in that area. So how do companies before Clearwater solve this? They have different solutions for maybe different asset classes or different regions or different regulatory requirements, right? And then, what you need for risk versus what you need for compliance versus what you need for your accounting results is different. And by the way, you have different systems for that. Well, so then what do? So then they say, okay, well, how do I get one view of the truth? So they kind of like cobble together a data warehouse. They kind of have a bunch of people running around trying to make sure that the data stays in sync, and they're doing all that stuff. And it doesn't work. Okay. It just doesn't work. So we kind of, our value prop is really that we provide you with a single set of comprehensive, clean, reliable data that you can go to use your day at the beginning of every day. Okay. So what we do is we say all of the machine that's done to like reconcile and fix all that, don't worry about that. We do that. You come in the morning, 9 a.m., and you hit a button. You want to know what your positions are. You want to know what's happened. You want to know anything that's gone on with respect to that reporting is happened. So a large insurance company, it might take them 10 days to close their investments. With us, 80% of our clients close on day 1 and day 2, right? So, and everybody's closed by day 4. Like and that's kind of a monthly close process where you have all this other stuff. But every morning, clean, reliable data. And you might say, okay, well, great. But like, why can't anybody else do that? And so that's where like I have to tip my hat to the founders who many years ago came up with a novel concept. They truly built a better mousetrap. So first of all, Clearwater's headquarters are in Boise, Idaho. So the first novel, they did 2 novel things. I'd like to say that they thought about it. I'm sure it's a little bit lucky, but the first thing they did was they said, we live in Boise, Idaho. I don't want to travel anywhere to install this software. So we're going to put it in the cloud. Okay. So number 1, it's in the cloud, but there's lots of cloud solutions. But number 2, and this is where the real brilliance was that they thought about it differently. Instead of thinking about your portfolio and my portfolio and someone else's portfolio and thinking about that, which is how most people think about it, they said, forget about anyone's portfolio. We're going to think about the securities that are underlying the portfolio. And so what they do is they reconcile at the security level. They model at the security level. We get clean, reliable, golden data at the security level first. It's a golden copy. And then you come in and you hit that button at 9 a.m. and you want to say, somewhere else we do the math where we say, okay, all those securities over there that we know are right. Okay, it's just your specific price time, your quantity versus all these prices. So why is that so incredibly valuable? It's incredibly valuable because if you have the same securities that I hold, we reconcile them once. Okay. And so what we find is now the flywheel is going. We're adding clients. Most of the clients we're adding in North America, we have millions of securities on our platform. 98% of those securities are already on our platform. But the great thing is for that 2% that are unique to those clients, we then add them to the platform. And for the next client, if they also have that security, then we're even more and more robust. And so because we have this golden copy, we're able to really get a ton of efficiency out of this process. And the flywheel effect is real. It's every client adds more securities, builds more scale, offers more regulations, so that we now have over 6 trillion in assets on the platform. And, that's a meaningful number. And so to be able to see that, you're starting to see kind of whole industries, what they're doing, how they think about, you'd have the opportunity to think about some interesting business questions.
Now, I want to just point out you joined in 2019.
Yes.
And I know the company's public today. It wasn't public when you first joined it. I don't know if it was a IPO or a SPAC transaction. I'm not sure how you guys went public.
We did in September of 20. It's a very different business today than it was as you would expect any business, right, to be. But we actually went public through an IPO in September of 2021. As a tech company CFO that has excess cash, right, I think to myself, what am I going to use this excess cash for? Like, if I'm money losing, then I need to be able to take this money and use it to fund my business at some point in the future. Which, if you're kind of cash burning, then you're doing that. But if you're a self-sustaining business, then you really are going to use that cash for more strategic ideas. Like, am I going to buy another business, or what am I going to? But you want to make some, you want to make a little interest. You want to make a little cash in the meantime, and that's what we really allow you to do, is to have the reporting, so that you're compliant with what your board wants you to invest in, so that you know your duration and you know when you can use that money again.
So what we want to understand a little bit about is, and again, I know you joined in 2019. We're looking back over the history of the company. Can you just give us a short, abbreviated history of this company, whether its capital structure over time, whether was there a group of investors from the very beginning, or what?
Sure.
What's
so
the story?
there were those 3 founders, 2 brothers and a friend, all in Boise, Idaho. They'd worked at Goldman Sachs and the Chicago Board of Trade, so they pretty sophisticated. They knew what good looked like, and they started this business. They actually started at trying to be an investment manager, and they couldn't convince anyone to give an unproven investment manager from Boise, Idaho, any money. So they built this software tool, and basically what happened was their prospects came and said, "I'm never going to give you the money, but I want that tool." And so they quickly pivoted and became a technology business. So that was 15 years ago, something like that. Maybe a little longer. And then in 2016, they sold 2/3 of the business to a private equity firm called Welsh Carson Anderson and Stowe, WCAS, or Welsh Carson. And so enter then shortly thereafter my boss, Sandeep Sahai, who's the CEO. So the founders said, "Okay, we now own 1/3. We'll stay on the board, but we'd like someone, the business is getting to a scale. It was about $80 million of revenue at that point. And we're, just for context, we'll be, almost 400. We were 300 last year, and we'll grow, kind of 20% this year. So it's doubled a couple times on that. Sandeep came in, and that was kind of 2017 when he stepped in, and then I joined in 2019. It was a very different business. Upon my first day, he handed me that Wells Fargo key fob that is like what you need to do to release like payroll and your payments. And I was like, "Oh, it's been a long time since I've done that." He said, "I know. And I was doing it before you got here." So I was like, so immediately I'm like, I got to hire a controller that's going to go take care of this. So that's kind of, so we kind of got the business, the business always, the business has been phenomenal, really good business model, really great differentiation in the product, always run profitably. And so durable, reliable growth, great business model, great business. We can get into that later.
Well, you explained it's a cloud business, it's a SaaS business, and it has probably all the same unit economic measures. At the same time, we're always curious as to what you've learned along the way in terms of what KPIs are you paying close attention to over time. And the thing I'm always trying to draw attention to, Jim, if there's a metric or a business dynamic that you've identified and have begun to measure, just because you do have all this data available to you now, and your FP&A team, no doubt, is studied lots of different dynamics, but to help you better understand the unique business that this is. So I'm going to ask you if you can just share some of the metrics that are important to you. And I know you're going to say renewable revenues and lifetime customer value, and make it interesting for us.
We're looking for evidence as far as how business is being measured in new and different ways.
I was going to say, I'll throw some acronyms at you, which you obviously will all already know. But yeah. So look, it's 100% recurring revenue business. It's SaaS. One thing is we're billed monthly in arrears, and historically, our bill was based on the AUM our clients had on the platform. So there's a little variability. That's why we would bill monthly, is you'd have to measure the AUM. So what do I care about? I care about annualized recurring revenue, ARR, run rate, right? And how does that grow? I care about gross revenue retention, which is really how we think about it is what's our run rate and what's our dollar churn. And really, I don't have to look at that. It's world-class. It's been 98%. But the difference in a business that has gross revenue retention of 95%, which is great, and 98%, when you look at that compounded over time, it's really meaningful. So gross revenue retention. Then, of course, net revenue retention, which interestingly, for as great as our gross revenue retention is, our net revenue retention is honestly pretty average. And that's because we've historically been a single product business. We gave everything to everyone, and the idea is you would just grow. So we'll talk about that a little bit later, but that's kind of that net revenue retention number is okay, and obviously well north of 100. But that's the important thing. So I also mentioned we've historically billed clients based on the AUM they have on the platform. So we look at the AUM, we look at client level AUM, we look at composition of the assets that make up that AUM, we look at total AUM. And then obviously we're looking at new business growth. What are our new logos? What are our bookings? That's kind of what everybody does. Every software company does. We're looking at customers, and we're looking at customers of size, right? Not only number of customers, but what are the real meaningful ones that we're doing that. Then that's kind of top line things that we think about. And by the way, how do you look at bookings? You're looking at it by team, by region, by market, we look at it in every different way to try and evaluate those trends, and then all those things upstream, pipeline, what's the source of that, how does all of that work, and then we kind of pivot to efficiency, because I believe in that businesses should make money, and so does Sandeep, and so we've always kind of historically been lucky enough to have kind of, call it 30% EBITDA margins. So, but really it comes to gross margin. A business that has an 80% gross margin is so fundamentally different than a business that has 30% gross margins, right? If you're a PC maker, you're looking at the teens. If you're Micron, you're kind of down that, and it's so fundamentally different than kind of that 80% gross margin. So we really focus on gross margins and thinking about that. And then we think about, what are we spending in R&D? What are we getting for that? What's our sales and marketing? So we think about efficiency. We think about, in all those contexts, what's our magic number? How do we think about R&D as a percentage of revenue? What are the components of that R&D? What's kind of net new? What are we, and kind of how all that fits. The last thing I'll say is that we look at a lot of client metrics. So we have a whole platform for engagement and client health. And then every 6 months, we send a questionnaire out to our kind of our relationship owners at our clients, right? Not everybody at the client, but the economic buyer is what we would think of. That's how I think of it. And we ask them, for their net promoter score. And we are lucky to have really high net promoter scores. I think it's because, first of all, we take all the pain out of it and you just kind of consume data from our platform. But it's also, we have an incredible client service team. And I think that has to do with like being in Boise and being scrappy and kind of starting on thinking, okay, what do we want to do? And so NPS, and then the last thing we think about is a bunch of employee metrics, which are, ultimately, what's your satisfaction? But thinking about that.
Let me ask about AI and ChatGPT. It seems like it's certainly part of the strategy discussion in so many companies. Since the start of the year, what about this one?
Yeah, it's certainly the ChatGPT has definitely really created what was a visceral concept into a very tangible concept in the last few days. We have always used machine learning in when you think about trying to reconcile massive amounts of data. We've always historically used machine learning. I'm not sure how dynamic. I wouldn't say that's AI that we use, right? I think it's machine learning, and so that's what we've done. We do think with the robust data sets we have, we could really start to think about AI. So we have a relatively small team, within our larger R&D function. We have people who are serving stuff for clients, people who are working on our existing product, working on our next generation product, and then working on our truly innovative, like next generation. That's what that team is in. And so but what would be interesting is, okay, well, how did people change their portfolios as a result of the SVB meltdown? Like, did just all the assets go down? Did people swing from one asset class to another? How did people think about that? And then starting to think about, well, how do I then provide an interface to someone where they ask a broad question like that in a verbal format, and then it comes back with some of this quantitative data. Wow, that's kind of exciting and interesting. So that's very nascent, and I'm just hoping to retire before AI has taken care of CFOs, my friend. Yeah,
you're not alone. No. We're going to jump to what we refer to as our finance strategic moment question, where we just ask you to share one moment of insight that you've had along the way during your career, an insight that only a finance executive or leader could have because of their lines of sight. What comes to mind when we ask for a finance strategic moment?
Okay, so fortunately, or unfortunately, there's thousands of finance strategic moments to go through, but I'm going to talk about kind of an event that occurred kind of last year, just because it's still in the top of my mind, and then how we reacted to it. So if you recall, we talked about how we had historically priced our fees to our customers based on the assets that they had on the platform. Okay, so and we call that AUM. So we have AUM based pricing. So we'd say, okay, you have $1 million on the platform. I'm going to charge you 1% for that. Here's your price. That's just illustrative. So back in 2020, when COVID occurred, right, and the S&P stock market went from peak to trough down 30% in the month of March. That was a really exciting time to see. And you know what happened to our revenues? 2%. So we thought, oh, we are impervious to AUM changes. Okay. Frankly, we had too much hubris, as it turns out. And so kind of this AUM model, and we've always really branded ourselves, particularly with investors, as durable, reliable growth, right? Then, okay, now fast forward to March, April, May of 2022, where fixed income securities dropped dramatically. Interest rates went up, and therefore fixed income security prices went down dramatically. Equity prices went down dramatically. Okay. And oh, by the way, because this is happening, our clients are trading more. They're actively looking at their, in times of stress, they're using our data. Our data has become more valuable than ever, and we're working harder to make sure that everything's going well for them. Meanwhile, our revenues are going down. Now, up until September of 2021, we were a private company. We had annual numbers, and generally this AUM, assets generally grow over time. So it's generally been, over the long term, it's a tailwind. And in the first and second quarter of 2022, it became a massive headwind. And it really was crystallized. I mean, we have this great business. We're next generation platform. We're displacing, legacy players in this replacement market all day long. The business is running terrifically. And I still remember the day. Sandeep and I had a day of investor meetings. And remember, you talk to 20 investors in a day. What was the one question that all 20 of the investors asked? What's happening to your AUM? We couldn't talk to them about anything else. That was the only question anybody asked us. Sandeep stood up from that day. He turned to me and he said, we got to change our business model. And I was like, wow. This is like, we're a public company. This is, business model transformations are not easy. They always take longer. They're always harder. What are we going to do? He said, Jim, it doesn't matter. We are durable, reliable revenue. We have great customer relationships. We deserve, kind of the revenues that we get. And yet no one is listening to any of that. They're only interested in the market volatility. And by the way, we can manage a lot. We cannot manage market volatility. So I was like, we need business model evolution. So my team does pricing, commercialization, price increases, renewals, that sort of stuff with clients. So it comes to my team. So he says, okay, this is what we got to do. We got to think about, so we sat down and we said, okay, what do we need in our business model while still having some of the benefits of this AUM-based pricing, but also having the security and the durability and the reliability? So we evolved our business model into what we now call the base plus model. And there's 4 components of it. Number 1 is that there's a base fee. When you sign up as a new customer, your book of business looks like this. We know generally what it's going to cost to serve you, and here's the price for that book of business. Okay? So that's your base fee. Then if your business grows, then there's a basis point fee on top of that fee. And then the third piece is that base fee goes up every year based on kind of normal business practices of everyone's used to paying a little bit more. And then the fourth piece, which is the most strategic but least impactful in the moment, was we drew a box around the product that we had today, because up until that point, we'd been a single product company, and we knew we had to move. We had clients that wanted different things, and we needed to become a multiple product company to grow. So those are the 4 components of kind of the base plus model. So we rolled that, and believe me, that took a bit of time to think through. And that's where, really we pulled together a SWAT team, right? We looked at a bunch of data. We thought about what to do. We have some really smart folks who kind of were able to come up with the structure. So we said, okay, every new client is going to go that way. Great. But so we've kind of solved kind of how the business model will work going forward. But guess what? It's May of 2022, and I've got 2022 numbers that we've got to make, right? So it's like, I got to make the numbers that I've committed to as a public company every quarter. And so, okay, that's not enough. We've got to go back to our existing client base, and we've got to tell them we want to modify our contract relationship to evolve into this framework. And this is where really the proof is in the pudding, right? Those NPS scores, you thought to yourself, well, we're going to find out. They look great. We're going to find out whether they're real. And so what we did was, for call it, our largest 300 clients, we went and we individually modeled kind of what their book looked like, when we, first got them as a customer, how they've evolved over time, and then we made some expectations about what do we think they might look like going forward. And we kind of came up with a bespoke model. Then guess what? God bless our pricing team. They got on the phone. They called folks. They said, hey, look, here's what's going on. Here's what we want to do. How do you want to do that? And started to go through and negotiating that. And that's where, the person who was interacting with Clearwater every day said, great, understand it, makes a ton of sense. Because we said, look, at the beginning of the year, you were paying us $1,000. Now you're paying us $800. We're doing more work. And, let's think of how do we create a win-win around this? And that was kind of at a very similar level what the conversation was. And, I was 6'4" when those conversations started. I'm now about 5'2", but, it does have a tendency to wear you down. But we were able to go through that process. And I think the learnings were, all that hard work that the teams had put in day after day, year after year, to build that relationship that enabled us to have that conversation and start with that conversation. People got it. People got it. And so the outcome was, okay, 100% of everybody is on the new model going forward, but 80% of our client base evolved to either agree to a price increase or this new contract model as a part of those conversations. And, it was still a, 5% headwind to the year, but we ended up growing north of 20%, last year, which is kind of what we've always kind of grown 20, 25% regularly and gone through. And so that solved the crisis, to say. But we also did something in evolving this model that's far more strategic, which is now we've set up this different business model that allows us to now start to do this multi-product model going forward. And so now the next goal, right? Because I talked about our gross revenue retention was fantastic. Our net revenue retention, just okay. So how do we make that net revenue retention better? We have clients that like us. We've got to sell them more. And we need more product offerings to be able to do that. And now we have a construct to talk to them about that. And so now we're kind of, that's kind of our next phase of growth.
Hello and welcome to 60-Second Stories from CFO Thought Leader. John McCauley is undoubtedly the first finance leader to tell us his path to the CFO office began in a swimming pool. Back in high school, McCauley explains he was a rebellious student with less than impressive grades when a stubborn and no-excuses water polo coach knocked him off his wayward track. According to McCauley, the coach's philosophy was rooted not so much in winning or losing, but whether the team had done everything in its power to succeed. For McCauley, this meant 3-hour practices before and after classes. 300 days a year. From those days on forward, CFO McCauley tells us he has championed the power of preparation. That story and much more on episode number 870 featuring CFO John McCauley of Calendly. Remember, the future of finance is listening.
We are going to jump to our mentoring round where we get to ask you several quick questions. We begin by asking you to look back again. We're wondering if you think back to that first 30 or 60 days when you were in the CFO office at Advent, the first time you were a CFO, that first 30 or 60 days, that person, what would you tell him? What piece of advice is it that you wish you could tell that person way back when? What would it have been?
There's good days and bad days for every CFO at every company, no matter what. And so I would say, not that we were in a foxhole when I became the CFO, but look, quote metaphorically, look around the foxhole and make sure that the people that are in there with you are the people that you really want to be in there with. those connections with those teams, the love, things get hard, and wins are so much richer when you're celebrating them as a team. And when those days are hard, just to be secure in knowing, okay, like, we don't necessarily know how we're going to solve this, but we know we have the right people given enough time to solve it. So I think it's really looking back at that team, thinking, knowing that you can rely on each other, and knowing that you must rely on each other. It's a team sport. And I think, it's no matter how great you are, things come up.
We always like to ask our guests to reflect a little bit on the personal side. Wondering if you have a personal habit, part of the daily routine, something that you're known for over time. People point it out to you, maybe, or they comment, that's how Jim does it. He's always done it that way. What, anything, personal habit or part of a daily routine?
So I'm pretty reflective, and so I try and reflect every day. Some people journal. I'll be honest, I'm not that rigorous, but I do reflect. I started my career asking myself at the end of every day, did I earn the money I made today or not? That was kind of a crass question to ask, but you'd feel good about, like, okay, did I do that or not? Now it's a little more elevated than that. I think I also have a family now, so my ignorance is displayed in just outright all the time by my teenage daughters, who explain to me kind of all of my faults in very specific and painful detail sometimes. And so I think those, honestly, it's a very busy world. I actually turn off my phone a lot, and I get away from my technology. You would think, oh, you've been in technology, there's always something you can look at. There's always a data point that you can get to. And I think backing away from that and reflecting, be it, some people do that while they're, there's something about doing physical activity and reflecting and being able to do that. You don't even have to do that. But there's something about taking that moment. People will see me walking down the street and they'll say, your lips are moving and there's no one around you. It's because I'm rehashing that conversation, rethinking through those things.
Oh, that's a great one. Thank you for that reflection. We wonder if you have a book recommendation for us. It doesn't have to be a business book. It might be something you escape with. It might be something that had made an impression on you way back when. Don't know. Anything come to mind?
So the one thing I was going to say is don't read a business book. Don't read a business book. I read a lot of biographies, again, because I think there's something that you can interpret and interpolate from all of those things. And then the other thing I would say is, if you're going to ask me what my favorite book is, it's probably the Harry Potter series. And it's because what I reflect on that is that we read that as a family, sitting in your bed with your kind of 8-year-old, 9-year-old, 10-year-old kid as you're reading those things. It's probably less about the story and more about the moment in time that's helpful.
Yep. Wonderful moment there. Certainly, how many children have learned to read via Harry Potter? Yeah, it's amazing over the last two, or is it already 3 decades? No, 2 and 25 years, perhaps.
Yeah.
But nice reflections for us. Thank you, Jim. We are up to our final question, where we're going to ask you to share your priorities going forward for the next year, that 12-month period from now. What are your priorities as CFO of Clearwater Analytics?
Sure. So obviously we have to continue to deliver, every quarter, every month, every day. But if you're going to look out a little bit, one of the most important strategic imperatives that we need to do together, and I need to lead, is really moving us from that single product company into a multi-product company. And the financial expression of that is that we see our net revenue retention grow to 115, or beyond. That may take more than 12 months, but I'm fully into that. And then I'm going to give you a second one, so we all have scorecards, and Sandeep loads us up with lots of scorecards. The other element of my scorecard is you went back to artificial intelligence. So there's a team that it's just a small team that actually they work for me, product and a few developers that are trying to pull insights out of our product. And we see that. I'm not going to say that we're running artificial intelligence yet, but the idea is we're building the frameworks and the groundwork. I think that could be, with $6 trillion in assets on the platform, that could revolutionize like investment management for everyone, for you and for me. We could, but that's far more than 12 months out. But we'll hope to maybe I can come back and talk to you in 12 months, and maybe I'll be able to tell you what that is. I don't even know what it is.
You have our invitation. Jim Cox, thank you for joining us on CFO Thought Leader.
Thanks so much.
Hello, Thought Leader listeners. As you have perhaps already heard or even seen, we're now featuring the career lessons and moments of strategic insight shared by our CFO guests as Thought Leader videos. You can now find these videos on our blog at cfothoughtleader.com and, of course, our newsletters, but also on LinkedIn. If you haven't already, please go ahead and follow our CFO Thought Leader LinkedIn company page, and you'll be certain not to miss a single Thought Leader video debut. CFO Thought Leader, the #1 thought leadership platform exclusively for and by CFOs. As always, thank you for listening.